Welcome back to the channel, folks. So today in this video I'll continue the indicator series by teaching you guys about moving averages. So what is a moving average? This is a type of an indicator that helps traders to identify a direction of a security more easily. The indicator smooths out the random price fluctuations and shows the constantly updated price averages via a curved line. Keep in mind that the moving average is a lagging indicator, and therefore when setting up a trade based on the signal from the indicator, make sure to do the price analysis first to avoid making a mistake. Only when used in conjunction with price analysis does this indicator show its true advantages. The moving average can be customized to use different time periods. So for example, if I'm using a 100-day moving average in my chart analysis, like the one you see on the chart, this means that the indicator is showing me the average closing price of the security over the last 100 days. By using a single moving average, we can identify trends. However, by combining two or more moving averages that are constructed using different time periods, we can get even more information about an asset's strength, weakness, and possibility of a reversal. Generally speaking, there are several popular time frames that are most commonly used by traders and the investing community. Here they are. 5 to 12 period moving averages are used by short-term or day traders who need to react quickly to fast-changing price conditions. When these time frames are chosen, there's much less lag when it comes to how fast the indicator reflects price changes. If the 5-period moving average is above 12, then this indicates strength, and bullish positions will greatly benefit when this occurs. For bears, the ideal trading environment emerges when the 5-period moving average trends below the 12-period. I will explain more about this later in the video. 20 and 50-day moving averages are used a lot by swing traders who prefer to use more polished and smoother lines to identify favorable conditions to either go long or short. This time period also produces less noise and fewer false signals compared to the time frame used in the first example. 100 and 200 period moving averages are commonly used by long-term investors. There's a very big lag when it comes to these types of moving averages because it takes a lot of time for the indicator to reflect the price changes. But this is perfect for investors because their investment time horizon is usually much longer, and sometimes they hold their positions for more than a decade. There are two major types of moving averages that are commonly used by chartists. One is called simple and the other one is exponential. The simple moving average basically smooths out data and applies equal weight to all price information that is included in the chosen time period. This is one of the easiest tools that can be used to identify trends. As I've said before, the longer the period that is used for creating the simple moving average, the more lag will be introduced. However, there's a big benefit to using 100 and 200 period moving averages despite the greater lag. The advantage is you get a very smooth line that makes the task of identifying major trends much easier and faster. The exponential moving average, on the other hand, is used more by traders who would like to emphasize their analysis more on the most recent price behavior of an asset. Unlike the simple moving average, which tracks data in the same way throughout the chosen period, the exponential moving average takes into account and places greater significance on the latest price information. This significantly helps traders who are generally engaged in shorter time frame trading. So if they need a quick analysis of the recent activity of a stock they're analyzing, then using the exponential moving average gives them better results. Let me compare the two averages on the graph so you can understand better what I'm talking about. When comparing the two moving averages side by side, I hope you guys see that the exponential moving average is reacting much faster to the recent price data. This is why some traders prefer it to the simple one. When using the moving average in the context of identifying trends, we should look for whether the indicator is trending upward or downward. If it is trending upward, it means that the asset is in an uptrend, and if downward, then the security is in a downtrend. If the moving average trends sideways or exhibits erratic behavior, then most likely the price is consolidating. A lot of the time, traders use the moving average indicator not only to identify a trend, but also to trail their stops when they have an active position. For example, in an uptrend, if the price mostly stays above the moving average line, then this indicates that the security's bullish sentiment is high and that the uptrend is likely to continue. This is a perfect scenario for a bullish trade where stop losses can be trailed just below where the moving average line is. However, once the price starts to breach the line, then this should automatically trigger the stop loss order, thus closing the position and letting the trader realize the gains. Now in the case of uptrends, the price breach below the indicator line does not necessarily mean that the uptrend is immediately over. It just implies that an asset might be entering into a consolidation mode before resuming the uptrend again. On the other hand, sharp reversals do happen from time to time once the breach occurs. Therefore, there's no single rule here. Every outcome will be different depending on the market situation present at the time. The best tactic is to be able to adapt quickly and re-engage in long positions if the uptrend resumes. In case of downtrends, the price usually stays below the indicator line, and this lets traders who have short positions ride the wave to the downside as well. Placing a stop above the indicator line and trailing it to the downside gives short traders protection against sudden price reversals. If the price breaches above the indicator line, this will result in either a beginning of a consolidation phase or a reversal to the upside. At this point, short positions should be closed and profits realized. During a sideways move in the markets, it's very hard to use the moving average indicator in an analysis. This is because there are just too many random fluctuations in price that result in many false signals. Since false signals result in frequent stop-outs, other indicators that work best in non-trending environments should be used to take advantage of a sideways market. I myself rarely use moving averages when analyzing sideways trends. Where this type of indicator shines though is when it comes to crossovers. These are indicator patterns that give traders a warning sign about impending reversals. There are two types of crossovers which are called the golden cross and the death cross. The golden cross is basically a pattern when the short-term moving average crosses above the long-term one to the upside. This is a bullish pattern that signifies that bullish sentiment is gaining strength, and therefore a reversal to the upside is in the process of happening or about to happen. When this crossover is accompanied by high trading volume, this further reinforces the bullish strength. There's much higher probability now that the reversal is going to happen. As much as this signal helps bulls initiate new long positions, it also helps bears exit short positions too. If traders see that a downtrend is about to end based on the golden cross signal, then they can tighten their stop and exit their positions altogether as soon as the crossover emerges. So in a sense, both bullish and bearish traders benefit from this formation if they can spot it. The golden cross pattern can be used as an entry signal by both short-term and long-term traders. Let's further examine the scenario where a day trader is trying to initiate a bullish position on the 5-minute chart of the Euro-USD Forex pair using this specific type of a crossover pattern. In this particular case, as you can see, I'm using 20 and 50-day period simple moving averages. As you can observe, the currency was trending sideways before making a big move to the upside. So let's examine closer and see where the golden cross happened and how the traders reacted. First of all, have you guys noticed the area where the crossover occurred? The golden cross formation emerged right after the price created a nice and fresh support area. When bullish signals from indicators emerge inside or very close to the support areas, this makes the buy zone very attractive. This is what traders need to look out for. In our case, right after these two positive events happened, the resulting bounce catapulted the currency to new highs. This is a classic example of a bullish confirmation trade. First, the trader spots a very clean and fresh support area. Second, the moving average confirms the support area by creating a golden cross. Third, trader waits for the pullback after the initial surge and initiates a long position once the price retraces back to the area of interest. Now, this example obviously depicts one of the best scenarios that can happen to a trader. But in reality, you also have to watch out for false signals. And this is where the stop outs or bad trades happen all the time if you're not careful. Take a look at the period of time during which the Euro-USD was consolidating. It became increasingly hard for a trader to make good trades based on signals that were coming from the moving average indicator. Anytime the trader went long based on the crossover signal, they were stopped out not long after. During these types of sideways trends, price usually becomes too chaotic, and it becomes impossible to interpret what the indicator is trying to show us. Therefore, the best time to use the golden cross pattern as a day trader is to use it during active trading hours when the security is in the beginning stages of a genuine uptrend. Once you open a long position using the cross signal, now is the best time to use the moving average to trail your active stop protection. However, besides using the first method when traders can exit as soon as the price penetrates the indicator line to the downside, There's also a second method traders can use to close a profitable long position. All you need to do is to wait for another type of a crossover to happen, at which point your bullish position should be closed. As you can see, I'm talking about the death cross. Although it sounds ominous, it's just a formation that occurs when the shorter term moving average crosses below the longer one. In our example, it's going to happen when 20 moving average crosses below the 51. This is when you can close your long positions and wait for another opportunity to engage the markets. The reasoning behind this is usually after a strong move, the price tends to take a breather and consolidate for a short period of time before resuming an uptrend. Trading during the consolidation period is not a very profitable endeavor. Therefore, if you want to increase your efficiency, then just move on and search for other trending securities instead. Since the death cross usually suggests a downtrend reversal, we look for an opportunity to short once it emerges. Now, how do we know whether the death cross is producing false or genuine reversal signals? One way to verify this is to see if the price breaches the major support area that was preventing the price from collapsing downward. This support area, along with the major resistance zone, usually acts as boundaries that keep the price from trending sideways. Once the bottom channel line of the sideways trend is broken and the death cross occurs within a short period of time, either before or after the breach, this acts as a confirmation that the reversal is underway. Now you can short on the retracement and make money in the new downtrend. If you are shorting on a smaller time frame chart such as 5-minute one, then make sure to open positions only during the most active trading hours. This is because the major moves happen during the times when the volatility is the highest. Once the reversal has been confirmed and we have opened a short position, we can use the moving average as a trailing tool to stay in the trade for as long as possible. Short positions can be closed once the indicator creates the golden cross, which usually signals either consolidation or a reversal to the upside. If you are a swing trader, then the most common combination that is used to identify crossovers is the 50 and 200 period moving averages. The procedure is very similar, except traders use higher time frame charts, which require substantially more time for trade setup to work. However, unlike the charts used by day traders, higher time frame charts produce much more reliable indicator signals, and therefore success rate is significantly higher. But generally speaking, moving averages and crossovers can be used on any time frame charts as long as the trader uses them correctly. So to summarize, the moving average indicator is used by traders to identify trends. It also allows traders to manage active positions via trailing stops. When two or more moving averages with different time periods are combined, it lets chart analysts identify potential price reversals using crossovers. Guys, I hope this lesson was informative, and if you liked the content of this video, please don't forget to subscribe and support my channel. In the next video series, I will cover MACD, which is related to this topic I discussed today. But until then, have a wonderful day and I will catch you in the next video. Cheers!